Good morning, everybody. I am Faith Ward. I am the chair of the Introduce Investor Group on Climate Change. I'm also a member of the Transition Finance Council Steering Committee. And I have the pleasure today to really examine the sort of critical question around how do we get the sort of transition finance flowing to companies and sectors who need it most in order to have that sort of credible and effective transition. And that includes answering all of your questions too. So again, do think of things that might sort of pop into your head as sort of stimulated by any of the topics we cover today. I mean, as touched on in the last panel, the transition finance guidelines are created to bring consistency and credibility to how transition finance can be identified, assessed and deployed. This matters not only for financial institutions, investors, but also the corporates seeking that capital to decarbonise their operations, strengthen their resilience, and invest in technologies and business models for a net zero economy. And I am delighted to be joined by Jonathan Dunn, Vice President of Anglo American, Ben Daly, Global Head of Transition Finance Advisory at Standard Chartered, and Angel Beltrán, Head of Capital Markets and Solutions at Santander. Together, we will explore what transition finance looks like from a corporate banking and capital markets perspective, and what needs to happen next to scale its impact. So, without further ado, I'm going to start. So, Jonathan, to ground the discussion sort of in the sort of practical realities, let's begin sort of from that corporate's perspective and sort of with Anglo's case, quite literally from beneath the ground. Could you outline kind of Anglo's sort of transition strategy and how the guidelines interact with that work? And what are the opportunities you think the guidelines present for sectors such as your own, which is like defined like hard to abate sectors?
Yeah, thanks, Faith. That's working. Thanks, Faith. And so look, starting from the beginning, I guess, I saw the opportunity to be involved in the Transition Finance Council and interact Anglo's approach with those guidelines is a really interesting test case, I would argue. And it picks up something that Irene was saying in the previous panel about those challenges of the hard to abate companies, sectors, or what have you. But if you're going to transition, you need to transition the whole economy. And you can't just focus on those things that are already supposedly green. So in addition, I would add, and I think I can say this because I'm a representative of a mining company, mining's got an absolutely terrible reputation. And it's not just about being a high emitting sector, it's also perceived to be damaging to the environment, negatively impacting social issues as well. And so there continue to be campaigns and problems all over the world against us as a sector. So there's a really interesting, as I said, test case. But as I think we've known for a long time, and I think is increasingly sort of obvious, mining's foundational to the global economy. Genuinely can't have the global economy without what we dig out of the ground. It's been the case for hundreds of years. I think it's probably become more clear with the framing of the phrase critical minerals, but it's not just the cobalts and the lithiums of this world. You can't function any electrification that was talked about before without an awful lot of copper. And so we set out our transition strategy, if you like, to try and answer those two questions. So what do we do and how do we do it? And so what we spoke about was we explained how we understood the products that we produce, the copper, the premium iron ore, and in future the crop nutrients as being really aligned with the lower carbon world we want. But critically, how we would do that, how we would mine it, and it picks up the point about nature as well, how you do it in the context of being consistent with, yes, decarbonisation trajectories, but equally expectations around the place. And that, I thought, fitted really nicely with the Transition Finance Council's approach to entity-level financing, which we think is really interesting. Because for a corporate, the idea of entity-level financing is a nice, administratively light, if you like, approach to financing, which makes it really attractive because labelled debt, what have you, adds additional cost for us, and at a time when cost is constrained, that was a challenge. So looking at that, then it was a question of how you make sure that what our transition strategy, as defined in our transition plan, said, fit with the guidelines of the Transition Finance Council. And that was a really interesting process as well. I'll just say one thing and then I'll stop because I know we're short of time, which is there's a real challenge always in having guidelines which are entirely rigid. You need to have standards. Of course you need to have standards, but one of the parts of the investigation into our plan was, well, look, the decarbonisation of your electricity supply in South Africa is necessarily going to be slower than in Chile. Because in Chile, we can go and buy through PPAs renewable electricity, and we've done that. In South Africa, that doesn't exist. So we have to build it, or we have to partner with others to build it. It will therefore take more time. Actually, the overall impact is probably more positive in that regard, but it will take time. So having a kind of linear trajectory for the decarbonisation didn't make any sense. And the interaction with the Transition Finance Council guidelines allowed for that nuance, which I think is a really powerful thing. I'll stop there, but we can come back to any or all of those points.
No, they're super, and then probably Ben, I mean, Jonathan's just really sort of brought to life there. There is a lot of complexity, there's lots of nuance in what's needed, and really, particularly in order to make transition finance scale. Standard Chartered was quite an early adopter of embedding transition finance into sort of your strategy. How do you find that this sort of helps when you're trying to sort of invest across multiple sectors and multiple jurisdictions? How do you sort of see it, and what's needed for these to kind of also to scale and to really deliver on their purpose?
Great. So, big question. If we just think about what Standard Chartered is, and for those of you in the room who may not know that much about us, so we are a sort of corporate investment bank in 50 of the world's most sort of dynamic markets. We've been around for a long time as well, so circa 150 years. So a lot of our client base would fall heavily into the hard to abate, heavy emitting sector. So the reason why we set up a transition finance team back in 2021 was we didn't want to make a net zero commitment in a vacuum, and we really sort of wanted to have a dedicated team, which is effectively where my team originated from, focused on the problem statements that were discussed at the very beginning of today. I start there because I think the reason why we published a transition finance framework was to really try and evidence why we were doing the things that we were doing, and provide a framework and a sort of standard to explain to our investors primarily, but also society, why we felt it was really important to lean into the mining sector, Indonesian clients, our Chinese clients, our Indian clients, etc., and why we really felt a sort of almost a shared purpose in trying to decarbonise these relevant sectors. Whilst my job is very much at the sort of the lending money, I'm a front office banker, I feel that having standards that we can rely on and that sort of set frameworks is hugely important. It really does help us, not just with our description of why we do things, but also deploy capital. So I think my sort of top tip, having gone through our own journey with transition finance, but also worked with Vanessa and the sort of the team on the City of London work, I think it's very much echoing Jonathan's point that you need a clear parameter, but also a degree of flexibility within it. And I think, again, the conversations that I'll have across the 50 odd markets that Standard Chartered operates in are entirely different between off to Germany next week to go and speak about battery storage. That's going to be a very different conversation to next month we're off to South Africa to have a very similar conversation, often with the same financial investor or sponsor behind the scenes, but the regulation, the speed of adoption is just so different that we do need to maintain a degree of flexibility.
No, super. I'm hearing that really clearly, and it's quite a delicate balance to have both consistency but flexibility, and how do we actually really get to operationalise that. And I think drawing and continuing sort of building on that sort of banking perspective to you, Angel, in terms of moving to kind of development of like deal origination, and how Santander's investment banking, how you can draw from that experience in how these are sort of helping to interact with your work and the opportunities that it's creating in the market?
There are broadly two ways in which then the bank can incorporate these guidelines. One is at portfolio level assessment. As many other banks, Santander has net zero emissions, and we have our transition plan, and we assess companies not only checking their environmental and social risks, but also some tiering system in terms of who are the most advanced, which companies have more credible targets, what are the ones that have more ambition in what they want to accomplish. And in those analysis, the guidance is a key element that they would like to consider. We have been road testing that, particularly during the drafting period within the working group in which Santander participated. But that, I will say, is more an internal type of assessment that typically then that disclosed to the market for the institution to be aligned with the commitments that has made publicly. But the other one, and it's probably more linked to my direct job, is the origination of transactions that are appealing not only to potential investors, but to the broader market. And in these terms, there has been a long discussion about very basic, probably, question on what transition really means. And the reality is that probably transition means different things for different jurisdictions and different sectors that are at different levels of development, that they have different dependencies, that they also have certain basic elements like best available technologies or risk of locking in that are not the same across the board. And just to make things a bit more challenging, these things could be different in 2, 3, 5 years' time. So what is probably considered as a line today might not be in the future. Making that appealing in a hopefully very condensed, simplified way that is typically the speed and the type of communication that is needed for capital market transactions at the in global space is something that is challenging, but in which we have received particular interest from both issuer borrowers and investors. There have been some developments in the market that have gone in tandem with the guidelines, the ICMA, LMA, European level, UK level as well, that has put together a bit more clarity on these questions and had given more comfort, particularly to investors to participate, which has been growing in the recent years.
So we're hearing this very strong signal about sort of the consistency, but if we're going to scale, you're also saying about the fact that it isn't really easy to kind of one size fits all. There has to be kind of, it's going to mean different things in different places. So what needs to happen with the guidelines to achieve that scale from in terms of both international interoperability, but to really sort of scale up? What do you think are some of the lessons learned we can from drawing from some of our collective experiences on dealing with these type of issues in climate finance and other areas? What would be your sort of takeaways and aspirations for the guidelines?
Also, it's twofold. One is more qualitative or soft, which is making transition as or even more appealing than green. There is typically for the broad audience, there is a knee-jerk type of reaction, considering that transition type of activities are kind of some level below what would be considered as green or best in class. This is actually financing transition, and tackling those issues are probably the most cost-effective and impactful activities that could be financed in order to reduce climate change and all the risks that we are seeing. So that's one thing. There's probably a marketing/education element attached to that, and the other one is more quantitative in terms of recurrently testing the guidance. Not all companies have the same level of rigor and data disclosure. Not all information could be assessed and is comparable across the board. So making that on a repeated basis with different sectors and with different types of companies is something that will eventually allow the guidance to serve as a benchmark. The principle-based approach and the combination of core and recommended elements, I think it's a key element that will make it more appealing and easier to implement in different jurisdictions because of the challenges that I mentioned, but it's just the repeated use of it which will make it successful.
We definitely need to get them used more. So Angel has set us the challenge of trying to make transition finance even sexier than green, Ben. So what do you think we can
Those
do
are your
with
words, but yeah.
with your
I wouldn't disagree.
With your peers, I'm paraphrasing. But with your peers to kind of, what do we actually need to see? What would be our kind of message you need to get out there in terms of making that happen, in terms of we really get those flows going?
Yeah, so I think the shared objective needs to be momentum. And I think effectively we've got almost 2 of the 3 buckets of people I think have got a really big role to play here. So firstly, corporate clients who are looking to raise debt or raise equity to really sort of identify this concept of transition finance as something they want to get involved in. So we start with an issuer in first instance. Then you need banks to start implementing policies and the frameworks within their various shops, and again, get behind the concept. And then we need investors, so looking right the way across the panel here, to actually also identify this as let's call it an asset class, that's something they want to have on their book and package and move through to their respective client bases. So I think that's the role of the Financial Service Centre. And I think obviously we're here in London today, and I think actually all 3 of those parts can happen very effectively in the City of London. The sort of the fundamental challenge still remains around bankable projects, and I think this is where society also has quite a big role. I do a lot of project finance work, or certainly asset level corporate finance work. This whole thing about having an offtake, having a demand signal that comes from society is basically the single biggest unlock for anything to do with green transition, sustainability. The labelling bit is frankly the least important. It's more about the outcome. So whilst obviously I'm sitting here promoting the transition finance concept, I think it's really about everyone taking a very clear ownership of their responsibility, but also society enabling the demand signals.
No, and I think if I could just jump in and sort of provide, obviously, I'm an asset owner, and taking that sort of responsibility sort of across that whole sort of capital chain. I mean, we're very much users, we're seeing the transition guidelines as a way of being able to demonstrate credibility to beneficiaries within pension funds, and also to try and help understand the necessity to invest in more hard to abate and how that's sort of essential, but show that these are credible investments, even within sort of a high climate ambition sort of portfolio, because we're wanting to do that across. It's not just about labels and products, although I think that presents some fabulous opportunities. I'm really looking for it to be able to demonstrate credibility across all of my sectors, all of my asset classes, so I can really show sort of what proportion of my portfolios are sort of moving in the right direction. And I really think it will help me be able to kind of communicate. For example, I've had to explain on a number of occasions why Anglo is in our portfolios. When you say, Jonathan, to sort of the public, that can sometimes feel a sort of that tension, but trying to demonstrate the criticality of that type of investment. So for me, I think it's trying to, it can hopefully elevate that conversation in so many ways. So probably bringing it back to you, Jonathan, in terms of that sort of going sort of full circle, about you've worked really hard on these guidelines as sort of part of the working group, supporting both Working Group 1 and my own Working Group 3. What is your sort of core, what's your hopes in terms of how do we get to the scale and deliver the real world impact? Because you're very much at that sort of, the face of that.
Yeah, I guess what I really don't want to happen first is that they sit on a shelf and nobody ever looks at them again. I see Vanessa laughing, but that's the worst case, that there's another set of guidelines which lots of great work by lots of clever people went into, and then they're never used by anybody. To me, what the work that the TFC is doing now in this year of looking at interoperability, I know there's work that I think John Williams is here, and Accenture are doing some work on AI, sort of working on how companies may or may not be aligned with transition finance guidelines, very easily assessing that, which is a really helpful scaling tool. I think scaling it is really, really important. But critically, I think it really agrees very much with what Ben said, that what you need to be seeing is outcomes. It's not an outcome for there to be new products in the financial services industry if nobody's using those products. What's actually got to have is the whole chain, as we've just described, with those companies, those sectors that I described at the very beginning, who are not automatically the focus of green finance, actually seeing financial flow to drive their contribution to and their part of the transition. That's success. How we get there, I think the work that is being planned is the right work, but only time will tell, sadly, as to whether it's successful.
No, well, I think it's very incumbent. I think everybody in this room and online, and I mean, I just strongly encourage you. These guidelines are great. I think we need to really to road test them, to trial them, to then share the successes, to then provide clarity on what we need in terms of how we've applied them in a whole range of different contexts to achieve that. So I really encourage you to take it off the shelf, give it a good read, and really get stuck into kind of using them to implement, and because they are absolutely vital, I think, to the journey we're on and trying to achieve that transition. So hopefully we've stimulated some thoughts and ideas within our audience here in the room. So I'm going to invite you now, we have some time for a few questions. So if I can see any hands. So do you want to start us off? Thank you.
Thank you for the panel. I'm Christian Long from Bloomberg. I have a question for Jonathan, because we have a lot of clients, asset managers and owners focused on the carbon footprint of the mining sector. And coal is a fairly easy sector to abate. And so the question for Jonathan is, how do you reconcile explosions and fires on underground mines, plumes of methane detected from space, with the progress the industry may be making in better monitoring and abating emissions from methane in coal?
So there's, what I'd say is two different things, right? Firstly, I talked about the foundational part of what we do. The transition of our portfolio is a transition away from coal completely. So we're in the process of selling our steelmaking coal assets in Australia when we'll only produce copper, iron ore, and crop nutrition. But that's ducking the question because the broader point is a really good one. And we've worked very hard with those assets to deal with the methane that are in those assets, which you can do. It costs some money. Open cut, very, very difficult, but with underground mines, you can either capture, you can use, and actually for much of the methane that come out of those mines in Australia, we sell it to power stations and use it to power homes. What I would say about other metals, quickly, if I may, is that I guess iron ore is the most interesting one for me, in that the emissions associated with the steel sector are huge. They happen almost entirely downstream of our operations, but nevertheless we're part of that value chain. But the world can't exist without steel. So there's a collective endeavor there, which the mining sector absolutely needs to play its part to reduce its sector of that value chain, but the overall value chain needs to be decarbonized because otherwise somebody has to come up with an alternative to steel, which frankly is not realistic. And I think actually coal is part of that conversation, of course, because you can have less emitting plants using coal versus the worst type. So there's a whole trajectory, and I guess it goes to the point of the Transition Finance Council overall, which is it's that whole of economy shifting towards something that we want to see. Hope that helps somewhat.
I think it goes to some of the points you were making, Ben, about needing to also stimulate the demand side for some of these the innovations, whether it be green steel, but we do need to actually sort of stimulate a whole economy approach to this, and as I say, take that responsibility. So you were.
I was just going to say, so one of the things that resonated when we rolled out our transition finance framework was a real focus on efficiencies, or certainly been able to work with the likes of Anglo American and say to them, like, we may not fundamentally, well, we definitely don't agree with coal as a fuel source, but there is still a lot of work you can do around the way you're developing your assets to make it less bad or more efficient, slightly more palatable language. And then actually being able to sort of revert through a financial product, saying actually, yeah, we feel there was a pretty significant emissions reduction or saving here. So anti-flaring projects, for example, a really great way to materially reduce the amount of methane leakage, venting, etc. But you need to be quite a confident organisation to be able to go say, actually, yeah, we're comfortable supporting this.
Yeah, really interesting panel, thank you. My name is John Clark. Most projects in the energy resources sector tend to be big capital outlays up front, and then you get your return over years and decades into the future. Those years and decades are a lot longer than a political cycle, and I'm not just talking about the UK. How are you, either as capital providers or project sponsors, managing the risk of the goalposts shifting and the economics looking, either better or potentially a lot worse into that medium and longer term?
Shall I take that? It's a challenge, and I think it's also the appeal back to those in the room who are in policy. Consistency is really, really important. There's a UK scenario here, but there's also, certainly from a Sanjar perspective, one of the challenges in a lot of our markets, and let's hope the UK doesn't get there, that is this long-term view of regulation. So generally we will look for projects that have got either a manageable or certainly a relatively small amount of exposure to regulatory risk, but it's something that we think about extensively.
I guess I should pick it as well. I mean, and look, we've only got a couple of minutes, so I could talk for hours about the issue. Clearly, there's a truism with mining is you can't move the mine, so you are where you are, and you might be there for 50 years. So your question is exactly right. What you have to do is build around that mine, therefore, an atmosphere, if you like, an infrastructure which is going to sustain through whatever political cycles and whatever challenges you have. Sometimes that goes wrong. Sometimes we don't get it right, but it's not through lack of planning. It's just it's a really difficult world. And frankly, if all the mines were just in really benign, easy politically places and easy environmentally, that would make life much more straightforward. That's just not the reality of where the geology has put the metals.
And how?
Yeah, just to add a quick element, banks and financial institutions in general, they have been very good at gathering information and assessing credit risk for years. And predicting probably the performance of different portfolios is something that is like bread and butter for many entities. Incorporating environmental, climate, and social risk is something that is way more challenging, not only because of the scope of the potential risk, so there are going to be far more in the future potentially, but also because of the lack of comparable data. These are, to a large extent, unprecedented territory in which we don't have comparable data or historical data to factor that in. There are some efforts, not only at institution level, but also at the regulator level. The ECB, for example, they are putting together the stress test, including climate, for the first time. There have been other regulators across the world that has been doing the same, and that will give a sense of the comparison points in which we can factor in those elements in order to make informed decision in terms of the unseen risks that were probably not very clear some years ago, but that now are coming to the surface.
No, and I think just to wrap the panel up, I think that's what's been great about the Transition Finance Council is the fact that this is a multi-stakeholder, including all those government partners. So I think the fact that they are around the table, they are working with us. And it's also a fantastic segue to our next speaker, who will obviously be sharing from a sort of UK perspective, sort of the Economic Secretary to the Treasury, will be joining us to share her remarks. And I think setting out some of, we've been really clear that sort of setting out that long-term vision and that consistency is absolutely critical to the success of transition finance. I think we can all get behind that, both in the UK, but in all the countries, that we need that consistent message. So I'd like to take the opportunity to thank my fantastic panels and thank you for your great questions. So thank you very much.